I'm Professor Arman Eshraghi of Cardiff University, and I am preparing this keynote for the BPS conference. So the paper I'm going to present to you is Transparency and Investment Decisions. Let me share my screen with you. Right, so specifically, we will be looking at this paper, Transparency and Investment Decisions, Evidence from the Disposition Effect, which my colleagues and I worked on and published in the European Financial Management Journal last year. So the concept of the paper is looking at social relations between investors in a social network and their impact on their trading decisions. Now, there has been a large body of academic research on investor behavior. However, and social relations and social influences on investment behavior. However, the impact of transparency in this literature has been mostly overlooked. And we also know that with the rise of fintech, there have been platforms known as social trading platforms, which have increased and facilitated the interactions between investors. So we look at these platforms. So these are platforms that allow users to observe and copy each other's trades. They can start trading through virtual portfolios, which are for most practical purposes like any other real portfolio. And they can get listed on the stock exchange, and they can act like fund managers by attracting followers. Now, there are many of these platforms around. The one that we look at as a representative example is Wikifolio, which is a German platform which has started trading in 2012, and it became quite popular in countries like Germany, Austria, Switzerland, and in fact in the rest of Europe. Now, on this platform, traders can trade using their real names or using pseudonyms. And what you can see, of course, at any given time is their performance from the time they started trading up until the present time, the amount of assets under management, performance statistics, and the fees that the platform charges. You can also see their current portfolio and whether they have lost or gained since they entered certain positions. And you can keep scrolling back and going through all the trades that a particular portfolio manager ever makes. So everything is completely transparent and visible 24/7 in real time. So the way this works is that any individual can start trading, and at first that portfolio would be in the test phase. It wouldn't be public or visible to the public, but once you go through a practice phase, if you're feeling confident, then you can publish your portfolio. So at that point, everyone will get to see your trades and your positions. And if you manage to attract at least 10 investors, and if you go through some verification stages, and the platform makes sure that you're an actual human, trader and can verify you and identify you, then your portfolio will become investable, will become almost like an ETF fund, which is tradable and investable by any investor in the stock market. So the question we ask is, as you saw in this platform, first we have no transparency, then we have more, and then ultimately far more transparency. So as transparency rises through these stages, what impact does it have on people's trading behavior, specifically on the well-known disposition effect? So we look at 2.2 million trading observations across Germany, Austria, and Switzerland. And we have data on demographics, on a number of other trader and portfolio manager level variables. Overall, those traders who manage portfolios on this platform, on average, manage about 80,000 euros during our sample period, which is not a lot of money, of course. So they're quite a small scale portfolio managers. And they, as you can see, they realize more gains than they realize losses, which is an indication of disposition effect. On average, their portfolios remain about 2 months in the test phase, about 4 months in the published phase, and then significantly more in the investable phase. So we look at the disposition effect. As we know, the disposition effect is grounded in loss aversion. So loss aversion is the idea that we dislike losing money far more than we enjoy gaining money of the same magnitude, sometimes by 2 to 3 times more, and so the so-called loss aversion coefficient. And this is in fact one of the drivers of the prospect theory of Kahneman and Tversky. So disposition effect then leads to the tendency to sell winning positions soon, but keeping losing positions. And it's a very robust finding in behavioral finance. It is documented well across various asset classes, regions, and time periods. Right. So we follow the model which was used in this literature by Heimer and Biru, and specifically we define a dummy variable called sale, which is 1 if a position is sold and 0 otherwise, and then a dummy variable called gain, which is 1 if that particular stock has gone up since it was bought, and 0 otherwise. But what we do differently from these models is that we also introduce phase variables for to indicate at which phase the position is in. So whether the portfolio is in the test phase, or in the published phase, or in the investable phase of the social trading platform. We also control for assets under management and the interaction between gain and assets under management. Now this first coefficient, beta 1, obviously if it's positive, it would indicate the existence of the disposition effect, and if it's negative, it would be otherwise. We also control for portfolio return, market return, Sharpe ratio, number of holdings, number of transactions, and demographic variables such as age, income, education, and lags. So what we find is that as you can see, this coefficient of interest, beta 1, is positive and statistically significant, which indicates the existence of the disposition effect. But interestingly, it tends to go down. Quite significantly from the test phase to the published phase and to the investable phase. So in other words, the magnitude of the disposition effect tends to get weaker as the portfolios become more transparent. We can also see this in the interaction terms, which are negative. So as a portfolio progresses to the published phase and to the investable phase, these interactions are negative, which points to the same direction and to the same conclusion. So why is that the case? At least one plausible explanation is that as portfolios go from one phase to the next, there's an increase in transparency and attention, and that increase in transparency could potentially explain the weakening of the disposition effects. So in other words, individuals become more aware that a large number of other users are potentially observing them. And because of that, they become more alert in their trading decisions. One sociological metaphor for this is the structure which is known as panopticon, which is almost like a prison with prison cells around a central guard tower. And the prisoners in the prison cells would never know if they're being watched, but there's always the possibility that they might be watched by the central guard tower. So when you know that you're being watched, you moderate your behavior and you become more risk averse, and you try to act more prudently, in fact. And so we think that as portfolios become more transparent in this platform, the investors become more prudent, and they stop keeping their losses to themselves. Now, of course, there are other potential explanations. It could be that what we see is down to survivorship bias, or it could be that our observed effect is due to perhaps learning on the part of the traders. However, none of those two channels actually explain our findings. So when it comes to survivorship, we dissect our sample into different subcategories, and we see that there is no impact of survivorship, really. So there is a negative coefficient both for the survivors and non-survivors. But you can also look at learning. So we can measure learning through looking at those traders which start with a portfolio and then maybe start another portfolio later. And the idea is that if you have had the experience of managing one portfolio, then your second portfolio should be better managed because you have had experience already. But we do not find that through this experience, people become better investors, really. So our coefficients do not show that kind of pattern. And in fact, there is very little time for people to become expert investors through this platform. So for example, you could look at the first 10 days or the last 10 days of each phase. And what we notice is really the fact that it is just around the phase change where the coefficients change markedly. So there's something about the status change from test to published to investable, which explains our findings. We also look at demographics, and we find that older investors behave differently in this context, and also richer traders behave differently in this context. And also, finally, we notice that as the size of assets under management increases, people become more prudent, because with a larger portfolio, you become more visible, you probably attract more attention, and therefore you're more careful when you're making trading decisions. Right, so the contributions of this study were to show that transparency can have a debiasing impact on the disposition effect, and presumably on a number of other behavioral biases in finance. In a different section of the paper, we also look at the culture of transparency on trading behavior by looking at differences between traders who live in East Germany versus West Germany, or what was historically East and West Germany. So the study potentially contributes to the literature on financial disintermediation and the literature on cognitive dissonance and saliency. Thank you very much for your attention, and I wish you the best. Thank you.